Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Thank you for tuning in. Fergus Hodgson, your host, with my co-host Brian London. If you are interested in learning more about mining, metals, the broader economy, please do consider subscribing on YouTube, BitChute, whatever platform you may be listening to. Now, we have Marc LoPresti with us today. He has an incredible resume with a lot of great Wall Street and financial experience. He is the founder and chair of the LoPresti Law Group. So, Marc, welcome to the show. And we want to get into your expertise in cryptocurrencies today. I mean, there are lots of topics. We're living in an age of disruption, you might say. One topic which Brian thought you'd have particular expertise on is the relevance of the introduction of central bank digital currencies. Will these constrain the growth of the blockchain and cryptocurrency sphere?
Well, first, thanks for having me, Brian. It's always a pleasure to see you, and a great pleasure to have the opportunity to address your loyal subscribers. Listen, central bank digital currencies we're already seeing them roll out in different parts of the world. China was one of the first sovereigns to introduce a central bank digital currency. You have to think about the use case for these CBDCs. They're not poised to make crypto irrelevant. In fact, they are potentially going to dislocate stablecoin and certain stablecoin applications, which is in part why you see such a focus from U.S. regulators on the stablecoin space, specifically within crypto right now. It's a focus of Chairman Gensler as now a year into almost his tenure as SEC chair under the Biden administration. So dislocating, making cryptos and blockchain less relevant, absolutely not. But they do have the potential to make things difficult for people that are participating in the stablecoin space. And why is that? Stablecoins essentially are tied or intended to be tied to a particular fiat currency. So that starts to look a little bit too much like banking and treasury activity for most governments. And when you add stablecoin with staking is the concept in blockchain of being paid to hold a certain currency at a rate of interest. Stablecoin plus staking starts to look a lot like a certificate of deposit or another type of transaction that most governments, including this one, say, hey, wait a minute, that looks a lot like banking activity. Who's regulating how much collateral you need to keep on the balance sheet? Who's hedging out the other currency risks that are associated with these types of products? But the stablecoin have the USDC's sovereign digital currencies have the potential to completely disrupt or dislodge crypto and Bitcoin. Absolutely not.
Yeah, Marc, I have my concerns with central bank digital currencies really are in two areas. One being, primarily the use case, because if there is a digital dollar, for use in everyday transaction in the U.S., I think that would become the de facto standard, other than any other cryptocurrency out there. The other thing, though, that concerns me is the official introduction into the realm is just another foot in the door, as it were, as far as regulation, et cetera. And it seems like the crypto universe, the crypto industry, as it were, has really been trying to get under the umbrella of regulation, of securities regulation, so it can present all these typical products, ETFs, futures tradings, et cetera, funds, and everything else. But once you invite them into the room, then they're not leaving, and they're going to start controlling the party, as it were. What are your concerns about that, about the regulation? Because part of the appeal of cryptocurrencies, the original appeal was, privacy, some insulation and isolation from official currencies and central banks, et cetera. what happens when you let them into the room, as it were?
Now, Brian, that's a great question, and it's also a hard one to answer. And we've got a lot of pieces of the puzzle that you've just put there on the table. So we've got the application of securities laws, we have the application of treasury and currency related laws and regulation. In fact, one of the biggest debates going on in this country right now is a bit of a turf war, if you will, between the SEC, the OCC, the Office of Control of the Currency, the Treasury Department, et cetera, the CFTC, over who's going to regulate and have jurisdiction over what element of the crypto market, because the cryptocurrency market, blockchain in general, it impacts and touches all of those elements, and it depends on what coin, what protocol, and what use case, right? And it's also important, I'll just touch on something you said before about the concern of a US-backed digital currency, a sovereign digital currency, becoming the de facto and making other cryptos irrelevant. Well, the reality of it is, Brian, there are a lot of terms and phraseology that are overused. Cryptocurrency is one that is very overused because of the 8,000 or 9,000 tokens, cryptos that have been launched in the past 3 or 4 years. Not that many of them, as a percentage, are intended to be used as a currency. They are actually, in many cases, their use case have something else to do with taking transactions that happen in the physical world, the traditional finance, or TradFi as it's come to be called, and putting it onto the blockchain, including things like how we transact, taking certain contracts and making them digital, transfers of land and title to land and things like that, payment processing, credit card processing, things of that nature that are not exclusive to the use case as a currency. So again, I think even if the government here in this country introduces a sovereign digital currency, I don't see it making the crypto space of any less relevant. So to the bigger question that you've asked is, once you let them into the room, well, here's the reality of it. In the course of the maturation of any new asset class, we saw this and we see it going on right now, even with cannabis, by way of example, or gambling and sports gambling in this country. For a new asset class, a new investment to come into the fore and have true wide-scale mass adoption, you have to have institutional participation. Institutions have to allow their individual clients to hold that asset in their IRA or their wealth management account or what have you. I need to be able to buy and sell it through some traditional transaction, the traditional means of finance that the mass of the United States or any country is used to transacting over. Not everybody wants to or has the ability to open a MetaMask wallet and a Uniswap wallet and move things back and forth and understand. So if you want mass adoption as an asset matures, you need institutional adoption. And if you need institutional adoption, that means you got to have regulation in some form or fashion. So the barn doors opened some time ago. I say this a lot, and I'll say it again to this audience. The largest catalyst, in my mind, of the appreciation of the price of Bitcoin and the other top cryptos during 2021 was that accelerating institutional adoption. And there are two things, and I think I said this to the audience at your conference not too long ago in New Orleans, one of my favorite cities in the world. There are two things that you can be sure of in finance, and there's very few things that are sure things. The two of them are assets gather value through their scarcity. Bitcoin will only be 21 million, so you've got the scarcity story there, which plays into inflation and a hedge, which I know we're going to talk about. And the other thing is regulatory adoption and institutional adoption drive and enhance the value of an emerging asset 100% of the time. So the crypto world is doing a very delicate dance right now, recognizing we got to let the regulators in some way, shape, or form if we want an ETF product, if we want mutual fund and 40 Act products to be able to transact in these instruments, and we do. So you can have something other than just a grayscale proxy for Bitcoin We saw, of course, with BitGo, the SEC a few weeks ago approving the first Bitcoin ETF, the first crypto-related ETF. That, of course, based on the futures that trade on the Chicago. So highly regulated exchange, lots of oversight. They were able to get their arms around it. But two spot futures, one by Grayscale and the other one, I'm forgetting the name of the firm that actually made the application, were denied on Thursday by the SEC. So you can see the regulators treading very cautiously in terms of approving these products. The Gensler administration, I think, is taking its time, getting to know and trying to really understand what all of this is about. Unfortunately, we have a very aggressive, recently appointed enforcement chair of the SEC. So I think we're going to see some continued, as the folks at Ripple will tell you firsthand, some regulation through enforcement, which is never a good thing. But there's no doubt they're in the room, Brian. To your question, they're in the room and regulation has begun. Some degree of regulation for this industry is definitely a good thing and will help drive further upside trajectory in the value of the key cryptos, Bitcoin leading the way.
And this institutional adoption, though, has that not proceeded largely in the absence of regulation?
No, it hasn't. So as you saw, starting with the regulators, the U.S. regulators, the SEC, the CFTC, and the Treasury getting together and saying a couple of years ago, okay, Bitcoin is a currency, and actually identifying whether or not it's fish or fowl was the first step towards putting some regulatory construct around that particular instrument. Now, there's a startling lack of clarity around the vast majority of the rest of the cryptos that are out there. So when we talk about institutional adoption, when we talk about what's happened in 2021, we're really talking largely about Bitcoin, and the rest of the market, by and large, although we've started to see dislocation in the past, call it 8 weeks, but by and large, where Bitcoin's fortunes, the rest of crypto follow. So we're talking about institutions like Fidelity, not only establishing their own, custodial desks, but the major other wirehouses from an asset management perspective, allowing clients and customers on the wealth management side to hold Bitcoin and Bitcoin-related products in their wallets. You don't see them saying, "Oh, you can hold Dogecoin," right? So, that distinction is something that would be the subject of its own podcast. So I'll go sort of as far down that rabbit hole as you guys would like. But the rest of the crypto world has, by and large, ridden the coattails from a price trajectory perspective on Bitcoin.
The Gold Newsletter is proudly sponsored by Inventa Capital Corporation, a venture capital advisory firm dedicated to the acquisition and development of assets in the natural resource sector. Today, Inventa is one of the premier mining groups with a first-rate portfolio of companies and a world-class team.
Hi, this is Brian London, and I'm here with our weekly CEO chat on the Gold Newsletter podcast. Every week, of course, we interview one of the executives from the Inventa Capital Group, with the Inventa Capital Group being our podcast sponsor, of course. And this week, we have the pleasure of welcoming back Michael Conart, the CEO of Vizsla Silver Corp. That is symbol VZLA on the Toronto Venture Exchange. Mike, it's been a while since we've talked, but it's been a heck of a year for Vizsla. A lot of accomplishments coming forth. And I think back earlier in the year when we had such a big run in the metals and silver mining stocks and a tremendous run in Vizsla. And back then, you were so much an earlier stage company. You've accomplished so much more since then. Your valuation still hasn't changed. It's cheaper, significantly cheaper, in fact, than it was back then. But you're a much better company. You know a lot more about the project, about the Panuco project, about the potential for the project. And in particular, you just returned from a visit to the project with your family and for some of the Christmas festivities, Christmas party for the people working on the ground, and were able to walk the ground again, and in this case with your family. And I think you have came back with, I guess, a renewed optimism for the potential for the project?
Yeah, it's funny. It seems like that every time we go down there, come back with this feeling of basically, a couple of things. One is the scale, the absolute scale of this district, and it really is a district. And that area that we're drilling for that initial resource in Q1 of next year is just such a small portion of what we have there. And every time we get down on the project, you just whether it's seeing it from a different angle or what it is, I always come back with this excitement about what the future has in store for us here, and what the conclusion that I drew. And I should say, of course, that we're in a blackout. We're drilling. We have constant drill results, and the resources coming up in Q1. So I'm unfortunately unable to be buying in the market. But I had this feeling of just how inexpensive this district is when I again walked the Napoleon vein. Went to the rest of the project, and then just seeing how well our team is executing on the ground, how we're moving the project, de-risking the project towards production. These things trade at multiple times the value of what we're getting right now. And of course, part of that is that we still haven't put out our initial resource that's coming in Q1. So there's a huge catalyst there. There's other catalysts coming in 2022, but like I said, every time we go down to the project, it come back, you just have this excitement about what we see here. So
yeah, I have the same impression and getting the same impression. I'm looking at a lot of silver companies. We're in kind of the I guess the last gasp of the tax loss selling season. I'm starting to see a lot of the juniors recover already before the end of the year. And I'm looking at silver deals, at junior silver deals, because they are so highly leveraged. Silver in itself is, I think, very undervalued and primed for a big burst higher in the new year. And then you have the silver companies, the junior silvers that are so highly leveraged to the silver itself. And that's a really exciting area of the market in general. So I'm looking at these, and I'm looking at some private placements too in some of these early stage companies. And they're all suffering, in my eyes, to what you have. And I look at them and they'll have great, early indications on some vein in Mexico in some cases. And, look at that, and it's one single vein. And it's a small vein, and they don't know anything about it. And they'll look at the veins that you're already delineating a very sizable, very high grade resources on one vein after another. And yet you look at the size of the property, and you've still only scratched the surface, and there's so much more to come. And you're discovering more with geophysical surveys, et cetera. It's really just scratching the surface of what you have so far. The resource estimate coming up, what do you think about the market's expectations for that? And what do you think about what that would represent as far as the property's ultimate potential, knowing what you know now about the signs for similar veins throughout the property?
Yeah, well, and what you touched on there is totally true. And just like that idea of just scratching the surface, I think is something that we always like to highlight. So thanks for bringing that up, because when I think about Napoleon and Tajitos, something else you mentioned there too, Napoleon and Tajitos, that they were in their own standalone company, probably each, would have a significant market cap, and it would be kind of, would be enough just to float a serious silver developer, I would say. Especially Napoleon. Napoleon is, almost 2 kilometers now in strike. It goes down about 500 meters, and it's open in each direction. The resource there, we've given all that information out except for the specific gravity. We don't put that in every press release, but in most of these press releases, when we update Napoleon, we give basically all the information one would need to do to kind of do a back of envelope estimation on that, as well as Tajitos. So I think, the market probably is underestimating potentially what we have here. Of course, we don't know what we have until the resource comes out. But if you do those calculations, you can see that we give that average width, average grade, and depth, and then we put out the specific gravity in one press release previously, which was 2.72 in terms of density there. So we're trying to do a good job of keeping the market up to date on what we see. But of course, these are looking back, right? These press releases are looking back at what we've already drilled. We're still waiting on some results to come in the resource area. So I think it's going to be very exciting, a huge catalyst for us because right now, I would consider that we're undervalued, inexpensive compared to what the potential is just on Napoleon and Tajitos alone. Now, when you consider that that's 5% of the overall, or less than 5% of the overall, cumulative vein strike that we know about in the district. Another way to say that is there's 20 times more strike than just Napoleon and Tajitos, or more than 20 times the strike of veins that haven't been properly drilled, or haven't even been drilled at all or explored at all. And that just speaks to the size, the scale of this district. But in addition to that, we have other tools, like you said, the geophysics, electromagnetics, just good old-fashioned prospecting to go find more and more and more discoveries. Another thing that stood out to me, of course, when you get down to the project, it's been there many times, but you think about, these geologists having to bushwhack to get to some of these targets. It's not like these are sitting in the middle of a desert outcropping veins. We made that discovery of Josephine 50 meters away from Napoleon, and Napoleon's been known about for some time to the old timers. So the propensity, the ability for us to go and find new discoveries, in close proximity to the workings that we know about, leads me to think that this is like having a San Dimas or a Fresnillo or any of these famous silver districts, but having it 500 years ago, like the same time that the Spanish discovered these things, because it's just so underexplored, this district, but we know it has the scale to compare to those famous districts.
Yeah, you make a great point when you said that you have 20 times the strike length in identified veins. A lot of companies will say, oh, we have this, and it's only 4% of the property area has been explored. But you're talking about identified veins that you know about, and yet there's going to be more veins discovered. I think that's obvious. So that in itself is going to be multiplied significantly. So lots of potential coming forward. And in the new year, that resource estimate, that's Q1.
Yeah, we're expecting to put that up by the end of Q1.
So that's a big catalyst coming up, where I think the market will see what you have. As you say, the smarter retail investors and the institutional investors have probably already come up with some resource estimates. It should be larger because you have more drilling coming up, but there should not be any kind of a shock to the market. So it represents more a catalyst and something that's going to tell everybody what you have, but it's not like the market is going to be surprised in any negative way, because people are doing their own resource calculations along the way. So a good catalyst coming up, I believe.
Yeah, absolutely. And most people that would be listening to this will be familiar with Vizsla, but we're still relatively, in the same sense that we're just scratching the surface here, we're still relatively unknown, in the sense of institutional investors, because we don't have that resource. So having a resource gives us something that appeals to even broader group of investors. So it is still getting in early, I would say, now prior to the resource coming out.
Yeah, a safer play though, because you have a resource that's coming out, and it should be sizable, and it will be very high grade. The other thing that I think we need to note, as kind of a parting comment, is that your resources should be more highly valued than other juniors, because you do have a mill, you do have the ability to move into production fairly quickly. Can you give just a quick thought on that advantage, and how much more quickly you would actually be able to convert resources into cash flow?
Well, if you were to look at a comparable project, let's say that's in, let's say Sonora or even Sinaloa or something like that, and it's not close to roads, and doesn't have power access, it doesn't have the HEDO agreements, it doesn't have, underground workings, and certainly doesn't have a mill. If you think about all of those things, we're years and years ahead of others. Whether we use the El Coco mill or another mill or freestanding, new mill construction to go into production, we haven't determined yet. Of course, the resource is going to be giving us the foundation to move into production. But just having that mill there and having those permits that exist with that mill, having the power lines, the high tension power lines that crisscross the property, the roads, that takes years off of a production timeline. And what I always say is that I think the market's going to be surprised at how fast we move into production. I can't give a timeline. Not until these studies or at least at the very least a resource is out. But I think it's going to be surprising just how quickly Vizsla could become the next silver producer in Mexico.
Yeah, and time is money, and that infrastructure is money as well, which cuts down capital expenses that other companies may have, and makes it a safer play. There's always the potential for a big company coming in. We're seeing the M&A market starting to heat up, but you have the option of very quickly going into production yourself, and that's the kind of a situation that guarantees a higher value in any M&A action that might come down the road. You are always the natural higher bidder for any project. Mike, thanks a lot for the update. Best of the season to you. We're winding down a big year for Vizsla, but if you look ahead, I think the next year is going to be even bigger, and we're not going to see these kind of values, in my opinion, for the company going forward. I think it's going to be a huge transformational year ahead for you, and the big news coming up in just a couple of months or so in the first quarter of that resource estimate. We'll be looking for it.
Absolutely. I'm very excited about that, and thank you for having me on, Brian.
Thanks to you, Mike. Appreciate it. You said something very interesting to me as a gold bug, Mark, that the regulators have come out and defined cryptocurrencies as currencies, which is
Bitcoin, just Bitcoin.
Bitcoin. Okay, yeah, Bitcoin as a currency, which is huge because that has all kinds of relations to taxation, etc. Whereas gold, which is specifically noted in the Constitution, is not only a currency, not only as money, but the only money, and not a paper dollar, is not regarded by the regulators as a currency, as money. How do we explain that? I'm wondering if that creates a chink in the armor where gold bugs can try and get gold finally treated, on an equal level, on a fair playing field with Bitcoin.
It's interesting, and you might say some of the Bitcoin people might ask the same question, right? There's lots of history and precedent for gold and how it's treated.
Yeah.
And I honestly, I don't know the answer to that one, Brian, to be candid. What we're looking at is very carefully is this relationship between gold and Bitcoin and which one emerges as a real inflationary hedge, right? Gold obviously being the traditional go-to asset class in a rising rate environment. Look, we have had, and I think we do the audience a disservice without at least setting the table for a minute here. We have had some truly unprecedented facts and circumstances for Jerome Powell, as I like to call him, at the Fed. This unbelievable cacophony of an ongoing 2-year plus pandemic, in addition to remarkably dislocated and screwed up, frankly speaking, global supply chain issues, rising energy crises, on top of everything going on in the labor market, the Great Resignation, perhaps the largest and most meteoric shifts, and I don't use those phrases loosely, in the labor markets, in part caused by the pandemic, but also in part just through complete sea changes in the way that employees view work and work-life balance and what's important to them and so on and so forth, trying to get a hold of inflation, trying to actually chart this course where you have to chart, 2, 4, 6, 8 steps ahead, 4, 8 quarters ahead, as the Fed suggested they would do at last week's FOMC meeting, suggesting ending the taper by March and then, 3 upticks in interest rates between now and the end of the year, and possibly another 3 or 4 in the following year. So this narrative about what do I do in an inflationary environment, like everybody watching this podcast or listening to this podcast, I'm pretty darn sure has concluded we are not transitionary in terms of inflation. This is an inflationary environment for the foreseeable future, unfortunately. So what do? Do you go to gold as many of your viewers historically have done? Do you consider Bitcoin as an alternative? Well, Bitcoin in the last 2 quarters, really quarter and a half, has underperformed in terms of acting as an inflationary hedge relative to gold. Gold has actually outperformed Bitcoin in the context of acting as an inflationary hedge investment. There are reasons for that, that again could itself be the subject of its own podcast. But I do think over time, Bitcoin will, for a variety of reasons, not the least of which, and perhaps the most fundamentally of which, its scarcity, Bitcoin will reemerge as a good inflationary hedge. The market is developing. It's really early, and both investors, institutional money managers, folks that are in the business of providing the instrumentality of trading Bitcoin and other crypto, we're still finding our way, right? So right now, doesn't look like a great inflationary hedge. I think it will emerge as such. I think it could emerge as such again as early as the second quarter of next year.
Yeah, I would agree with you, Mark. As a gold bug, I've been victimized with other gold bugs by the Bitcoin or the crypto maxis who are talking about how gold is a barbarous relic, and and Bitcoin does everything gold has done and historically much better. So but despite that fact, the fact that gold has performed fairly well as an inflation hedge over the last few months, when we've seen inflation really reemerge onto the scene, I've resisted the temptation to gloat, because I do recognize that it is early, very early in the story for cryptos in general. And right now, Bitcoin specifically, I think trades more like a speculative stock, more like a Tesla, kind of a pre-revenue tech stock. And nobody really knows what it's going to be, but they know it's going to be something big. But nobody really knows what it's going to be down the road. So that is very interesting to me, how this whole inflation story plays out. And in the Fed, you're right. A lot of this is of their own making, of course. But I don't envy Jerome Powell. I don't know why he sought renomination, why he wants to to be around when it all falls apart. But there's a gold bug in me coming out again. Mark, you're really involved in the venture capital end of the crypto space and the blockchain end, and how that's revolutionizing so many aspects of life and business and technology. Can you tell us some of the things you're seeing on the horizon for crypto, some of the things you're involved in? Because I know that if you see something really compelling coming up, you find a way to get involved, and have been so, which is really smart. What are you getting into these days? What do you like? What's exciting to you in the crypto world?
Well, so without naming individual names or companies, which I really don't like doing in these contexts in particular, we'll talk about some themes. And there are a couple of themes that really stand out, and that we are actively either investing or considering investments in the space on the VC side. And one of them is the intersection of neobanking and blockchain. So neobanking is this unbelievably exploding industry of technologies, most of which, or many of which, are blockchain enabled. So using the technology that makes things like Bitcoin and other protocols, other cryptocurrencies possible, but without necessarily involving a coin or a token itself. So things like there are so many transactions in traditional finance that have multitudes of intermediaries, and intermediaries that charge a toll or a tax along the way. Whether you talk about settlement of stock, equity stock transactions, processing of credit card transactions, coupons and customer loyalty type transactions. Consumers don't realize But in many instances, for the processing of a credit card transaction, there's as many as 6 intermediaries that add delay and cost that's paid by you, the cardholder, not by American Express, MasterCard, or Visa, that in a blockchain-enabled world where you can settle transactions on chain immutably, meaning that the transaction is written in stone, if you will, on the blockchain, one of the great things about blockchain technology, and instantaneously ensure that the parties get paid and charged what they need to get paid and charged, does 2 things, right? It speeds up transactions. So retailers no longer need to wait 3 days, 5 days, 2 weeks in some instances, and customer loyalty in the coupon space, as much as 30 to 90 days to get paid, but immediately get paid in a way that's verifiable, that has eliminated all of those tolls, those toll booth fees that those intermediaries that are adding no value to that transaction chain. So we are looking a lot at technologies that are using the blockchain to revolutionize different segments of traditional finance, including in the payment processing and remittance and neobanking space, but also in terms of how we interact with our banks. I mean, it's funny, if you go to your local Chase, and I'm not calling Chase out for any particular reason, and you deposit $1 million with them, they're happy to take it. But if you come back the next day and say, I'd like to take that $1 million back out, they say, well, sorry, we can't. We can only let you take out so much. Okay, well, what are you going to pay me for that $1 million? And how much of that $1 million did you keep on the balance sheet? There was a, I think it was McKinsey, there was a report of a survey that was done of millennials a couple of months ago, that 3 out of 5 said they would rather go to the dentist than walk into a bank branch, and that same 3 out of the 5 couldn't tell you where the local bank branch was for the bank that their accounts are at. Blockchain and decentralized finance are going to dramatically change the way we interact with our money, the way we interact with our banks, the way we interact with our credit cards, the way we get loans, in ways that will be accretive to the consumer, that will allow us as consumers to keep more of our money. We're also looking at themes around next generation commodities. As Brian, as you know, I've been a data bug or data nerd for a long time. I co-founded a company called Battlefin some 8 years ago that's in the alternative data space. Data is, as many have said, going to be something like the next oil, in that it's becoming highly commoditized, and its relevance is ubiquitous across the economy globally, without a question. So we're looking at how we can express commodity-like theses into non-traditional commodity sectors, data being one of them. And then the last theme, and this one you can't really deny, is the metaverse, which also is another place where blockchain technology, online gaming, work from home, and all of these things that the pandemic has driven. Unfortunately, it's desocialized the society as opposed to anything else. But Facebook changing its name to Meta is definitely an indication that there's a lot to watch in that space. So we are looking carefully and making some investments in metaverse related plays.
Now, is there a blockchain application in the metaverse arena?
Yeah, it's the way that participants in the metaverse interact. It's all going to be based on the blockchain.
You'd mentioned immediate clearing of transactions, et cetera.
Yeah.
That immediate part has been more theory than practice, though, as volumes of transactions have grown so quickly in the short history of cryptos and short history of the blockchain. Are there any applications now to try and speed that up, where they maybe don't clear on all the ledgers, or the processing time comes down to where you can? Because it seems to me that if you actually achieve that immediate aspect of it, then that opens up a whole new world, or opens up the world that everybody really envisioned for the potential of the blockchain.
So it depends on what kinds of transaction clearing that you're talking about. there is, I believe, the technology presently to replace the current T+2, used to be T+3. We're talking about trade date plus X number of days for you when you buy or sell a stock. There are protocols currently, and again, this is where we start to talk about this Bitcoin, and then there are the use cases for all of the other thousands of cryptos and crypto protocols, blockchain protocols that have been developed in the space. There are some very high-speed protocols in terms of clearing and settling. There are many that have been built for speed. Hedera, by the way, Hedera Hashgraph is one of them, which has, in some instances, usurped Bitcoin and Ethereum in terms of the number of transactions, and transactions meaning a variety of things depending on the use case, but transactions being processed over that protocol. I don't think in the case of equity clearing, Brian, that's the issue, whether or not blockchain or one of the protocols can handle it. There's just way too many incumbents that make money. One of them has a 4-letter acronym, starts with a D and ends with a C, that does not want to see that happen, which is really unfortunate, because that's why we still have naked shorting and a whole bunch of other market abuses that the SEC just can't seem to lick.
Yeah, we used to, when the crypto universe wanted to get futures trading and everything else, us gold bugs were sitting on the sidelines, kind of smirking. So, like H.L. Mencken, be careful what you ask for, because we've seen some of the manipulation that is enabled by futures trading in the gold market, silver market, et cetera, and other commodities. Any market that's of a Goldilocks size, where it can still be moved by the algos and is big enough to yield sufficient rewards for that kind of capital being moved, that it's going to happen. And I think we saw that. What happened a few weeks ago over that weekend when we saw the Bitcoin take, and really the crypto universe kind of take a dive over the weekend? Do you have any insights into that for our audience?
I wish I did. I sat there watching it, asking myself, what the heck is going on, and I was asked a lot on the various media outlets, that following Monday, what the hell happened. Look, you've got, and I'm looking at what we know. Okay, so there was no major FUD events. FUD is fear,
right,
uncertainty, and doubt, right? So there was no major FUD event that happened, like China banning crypto mining, or Singapore deciding that anybody that's got a crypto account is going to get caned and go to jail for 3 years. There was no individual event of fear, uncertainty, and doubt to pin that price action on. So the only thing you can say is, you're looking at, we're coming into the end of the year. You've got, these are as of taping today, Bitcoin, notwithstanding the recent retracement, 60% up year to date. Ethereum 400% up year to date. People that buy and trade cryptos do year-end profit taking. They do some year-end tax loss selling. They do look at macro conditions and say, hey man, we've got some uncertainty. That was obviously before the FOMC meeting. That was after the Omicron stuff had started, just after Thanksgiving, but before it sort of came to roost in the way that it did this week. You saw a lot of institutional asset managers on the equity side starting to risk off, saying, hey, look, if I'm a global macro guy, I'm up 23, 24% based on most of the surveys. If I'm an equity long short guy, probably less than that. I've underperformed the market, but I've still made money year to date. Ain't no point in going into the last 3 weeks of uncertainty of the year if I'm up. Take some cards off the table, maybe take all of them off the table, take some profit, do some tax loss selling, and get out. And that's what if you look at the trading behavior, and of course, when it comes to Bitcoin and crypto, it's all quote unquote on chain, right? So there's actually a level of transparency that's not afforded with traditional securities trading. So we can see, we can whale watch. We can see what the whales are doing. We can track how long-term LTH versus STH, long-term versus short-term holders of Bitcoin and other cryptocurrencies, how they're behaving, how long these instruments are being held before they're sold, what the turnover looks like, and looking at, or reading all those tea leaves, because that's what they are when you're trying to understand a weekend like we had 2 weekends ago or 3 weekends ago. Those are really the only conclusions that I could come to.
Yeah, you want to get the hot money into a sector to drive it up, but then, it comes with the other side of the coin that hot money comes in and hot money goes out. And all you really need once you get in a leveraged state is a couple of dominoes to fall. So we've experienced that in the gold sectors. It is remarkable how a lot of the similarities between the cryptocurrencies, between Bitcoin in particular and gold, are really coming to the fore. So will be interesting to see how it all plays out, of course.
Yeah, and listeners, you can see that Marc obviously has a heck of a lot going on, and we'll include a broader bio on the show notes. But his website is thestrategicfunds.com.pr. So go there to learn more about his work. Otherwise, Marc, we could speak for a lot longer. I look forward to next time. I'm shocked that it's taken this long to get you on to begin with. But so thanks for your time, mate. Cheers.
Marc, thanks for you and John Najarian coming to the conference this year to open up our audience more to this world. You're really at the cutting edge, the bleeding edge of the sector, and really brought a lot of value to this year's event. And we look forward to you contributing more through this medium and also the conference going forward.
Well, Brian, can't thank you enough for having us. We had a hell of a good time down there with you and the entire loyal audience that you have for that fantastic conference you've been doing for many years. I'm going to volunteer John for this podcast. So just go ahead and have somebody send him a bunch of dates, but I'm sure he'd be happy to do it as well. And a very happy holidays and stay safe to you and the audience, everybody. Thank you so much for listening.
Thanks, Marc.